Hi, this is Charles Kelly. How are you doing today? I'm the author of the book Yes, Money Can Buy You Happiness, and was also a financial advisor for around 25 years. And I've met thousands of people in various situations, dealt with their money problems, and they've kind of told me things that they probably wouldn't even tell their own family. So I've got a lot of experience in dealing with people, particularly on money issues. So what's happening today? Well, I wanted to highlight something that is probably gone under the radar in the last few years, and that is the fate of up to 170,000 borrowers who are trapped in higher rate mortgages. And this can be for various reasons, which I'll go through in a second. But they are basically trapped in mortgages paying 6 to 9% for their mortgage. And you might say, well, okay, why don't they just switch lenders? Well, that's the problem. A lot of them can't switch lenders because the rules have changed since they got that mortgage. Now, a lot of these date back to pre-2008, pre-financial crash, when lenders were, giving out mortgages, almost like throwing them around like confetti, and people were able to borrow 5, 6, 7, 8 times their income and get mortgages up to 100%, sometimes even more than 100%. That nationwide, the Northern Rock at one time were giving out mortgages of 125% of the value of the property. Now, that sounds a bit crazy, but actually at the time it made sense. I used to be in the mortgage business, and I spoke to nationwide managers, and they had quite a strict criteria. They checked, they dotted all the I's and crossed the T's and made sure that people could afford it. But their reasoning was, well, if someone's going for a 100% mortgage, and this is the time when properties were going up in value, of course, if they were going for a 100% mortgage, and then they found, well, I need a new kitchen, or I need new furniture, and then they went out and borrowed money from banks on personal loans or HP or credit. Those loans were much more expensive than if the Nationwide just said, well, if you need another 10, 15, 20,000 pounds, have it from us, and we'll charge you, at that time maybe 3, 4, 5%. I think rates were a little bit higher then, so perhaps you were looking at maybe a 5 or 6% mortgage. And so a lot of people took these loans. In fact, Nationwide didn't go bust because of those loans. Nationwide went bust because they got into commercial lending, which that then caused them a lot of problems. And other lenders like the Bradford and Bingley got into trouble because they bought lenders like GMAC, who were lending, non-status, self-certification. It doesn't matter if you got county court judgments. So they made a fatal error in buying that lender. And I spoke to someone at the Bradford and Bingley who worked there, and she was in the processing department. And she said, well, between you and me, when they started looking at the loans from GMAC that were not being paid, they found out that GMAC, now listen to this, GMAC didn't have the same lending criteria and checks that we did. Hello, were you not supposed to check that before you bought the company for millions of pounds? Anyway, to cut a long story short, that brought them down, and that those kind of decisions brought down lenders that have been around for sometimes 100 years because they got out of their comfort zone and started lending on commercials and all sorts of other deals, which then caused them trouble, and especially when they got into adverse credit loans, which and the adverse credit, that means lending to people with adverse credit, with previous problems, with previous repossessions, previous bankruptcies, previous county court judgments. When you lend to those people, strangely enough, a lot of them have problems again. And this was triggered from America and then come over here. And it's a long story, but basically those loans were sold off as a package. They were securitized, sold off as a package of securitized lending, and they were treated as securities, like buy these things and they'll give you an interest or a return on your money. Well, of course, these were like junk bonds, really, and it was a big scandal. But a lot of mortgages are sold off. When you borrow from your high street lender, you may end up paying back your loan to another party. Now, in the case of Northern Rock, people got mortgages from Northern Rock maybe on a fixed rate initially, and then when they went bust, they were taken over by the government, and then they were sold off to another party who said, thanks very much, we'll just sit on these mortgages and earn interest from them. But these other new companies did not want to offer new loans or new mortgages and change any deals. They just wanted to sit on the deals that they had. And of course, these variable rates were higher than they are now. So it's sometimes between 6 and 9%. Sometimes people had a mortgage of maybe a 3% fixed, but then went on to their variable rate, which could be much higher. And in this case, it was 6 to 9%. And I had a mortgage with the Mortgage Express, and when they went under, because they were part of Bradford and Bingley, they were still, the mortgage still stood there, and I could keep paying that mortgage, but it didn't go up to a higher rate because I think it was on a discount deal. But eventually I sold that property. But a lot of people are trapped in these loans with Northern Rock and other lenders, and they can't switch because they haven't got the income to go to another lender. Some of them are low paid, some are key workers. They can't go back to the lender and say, well, you gave me a fixed rate before, could I have another fixed rate? Because they say, no, we don't offer anything. So they're really trapped. And some, you might say, well, sell the property, but that's their home. Some of them are near retirement. They can't even get a mortgage even if they wanted to, because the rules again were tightened up. After 2008, the Bank of England stepped in and said, no more non-status. You can't lend to people over a certain age. You can't just have these never-ending mortgages. And we're tightening up the affordability criteria. So MPs now have called on the Competition and Markets Authority and the Financial Conduct Authority to look at some of these lenders and say, well, you can't just keep ripping people off and charging these higher rates. So they want to try and cap the profits made on standard variable rates. Now, I think this is a good thing because a lot of people are on fixed and discount deals, and I had this recently where I'd come off of a fixed rate mortgage, and my payments were going to double if I didn't refix with this lender, and to change lenders, and my payments would have doubled had I not gone with their fixed rate and paid, I think it was a £2,000 fee just to fix with another rate. So this is becoming a quite an issue. You think you've got a rate of 3%, but actually you've got a rate of 3% plus a 2% fee, and then in 2 years' time, when you want to then change that rate or extend that rate, they say, well, here's another fee for you. Here's another kick in the nuts. Here's another £1,000 fee or £2,000 fee, or you go onto our standard variable rate and then you pay 5 or 6%. It's a bit of a rip-off, really. In the past, you took out a mortgage and you didn't pay any fees. You just paid the survey fee, and you said, well, the lender's going to earn all this interest over the next 25 years, which could be 2 or 3 times the mortgage amount. Now the lender wants to have their cake and eat it. They want all the rates, the interest that they're charging you, which is sometimes 10 times more than the base rate, the minimum lending rate. And they want fees, and they want these fees ongoing for the rest of your mortgage. And at the end, they charge you a redemption fee or a return of deeds fee. Here's your deeds back, which are now electronic, and we'll charge you £300 for that, and another charge for this and another charge for that. So they're making a lot of money. So I think they need to look into this, because the standard variable rate used to be really a standard variable rate amongst all the lenders, all the building societies. Now the standard variable rate is whatever they want to charge you. This is what we think we're going to charge you. So this is the rate, and you can like it or lump it. Now I can lump it because I can say, well, I'm going somewhere else, but a lot of people can't. In fact, the FCA, the Financial Conduct Authority, reformed some of the affordability rules last October to enable lenders to help these people that are in trouble, but none of the lenders have changed their criteria. None of the lenders have helped these people. So now MPs are calling on the government to do something about it, and I agree with them. I think the lenders are really having their cake and eat it, and they're ripping people off. Because think about it, when I got mortgages years ago, say the base rates might have been 6 or 7%, and I was paying maybe on a mortgage 9%, maybe 10%, maybe 2% over base. But now the base rate is like it's less than 0.25%, and the loans are now 3%, which is like ridiculous amounts over base rates. What was it, 12%, 12 times more than the base rate. Sometimes they're 20 times more than the base rate. That they can get hold of money on the money markets really cheaply, but they're lending it out to us at ridiculous margins compared to the base rate. Look at credit card companies. They're still charging 16, 18, 20% when the base rates have gone down from, what used to be, I remember base rates being 12%. Now they've gone down to almost zero. They can get that means the banks can get hold of this money at that type of rate. Also, the banks are paying us when we put money on deposit at almost zero now, and yet when you want a loan, it's 6, 10, 12%, credit cards 16%, mortgages, yes, it might look good at first that they're charging 2%, which is, still quite a big margin compared to the base rate. But then that 2% is only going to run for a certain amount of time, and then they're going to say, right, you're going onto our base rate at say 5%, 4%, or we'll give you another fixed rate, but then we want a fee of £2,000 or £1,000 or whatever it is. And by the way, this is it. This is one product we're offering you to go on, and that's it. We're not going to give you any of the full range of products that we'll give to new borrowers. You're an existing borrower, so we can afford to screw you, and we're just going to give you this one product. But if you're a new borrower, yes, here's all these lovely deals. So I think something needs to be done about that. And one other thing I want to mention today is the self-employed scheme for the government have offered to help self-employed people. That the phase 1 grant scheme is only available until the end of today. So if you haven't applied, do that, because you can get a grant to help you through this difficult position, because we're still in this coronavirus situation. A lot of businesses have not been able to fully open. That includes restaurants that can only maybe have 25% capacity for customers, and lots of other businesses that are not fully operational. And even when they are fully operational, people are not going to necessarily use them because they're still worried about this virus. So do apply for that loan. I'll put a link up on the Facebook page here. And thanks for listening. Thanks for joining me. If you do want to get into e-commerce, by the way, there's a webinar coming up in about a week's time. Have a look at the link on here. And thanks very much for joining me. I'd like to also thank people who are joining me on Facebook Live. Tracy, hi there from Vietnam. Great to see you. And hi to Austin, old friend. I don't know where he's from now, but he was in Islington the last time I spoke to him, in trendy Islington. But hi to everyone on Facebook. Other news is that the Nationwide is starting lending again to riskier borrowers. That you remember they cut for first-time buyers. They cut it from 95% loan to value to 85%. They've opened up a little bit. Here in the UK, in case you're interested, travellers are now arriving in the UK from various countries, no longer need to self-isolate. People are getting back on holiday again, but from what I hear, the holiday resorts, particularly in the UK, are not at full capacity because people are just too nervous about travelling and worried. Some of the beauty salons have been able to open, and not gyms completely, but some of the open air gyms. Now, I don't know that many open air gyms. Maybe they mean a gym that puts all their stuff in the car park. I remember one at Regent's Park years ago, but we haven't got the weather here for open air gyms. This is not California or Florida. And the Eat Out to Help Out scheme, the website is open today, I believe, to register for that. So restaurants can register to go on to a Eat Out scheme or meal deal scheme where the government will pay half the cost of the meal, up to £10 a head, if you eat between Monday and Wednesday. We obviously had the stamp duty reduction last week, and hopefully that will start to build the property market again, because the property market has been literally on the floor. So if you're interested in property, you want to create a second income, again, drop me a line, and there's lots of courses available to help you to get into property or small developments, which I think this will help on, and maybe change your life, because I think a lot of jobs are going to disappear and won't come back. Already big companies have said, despite the government £1,000 per employee brought back from furlough into a job, big companies are saying, well, no, we can't do that for everybody. In fact, John Lewis and another retailer said they're going to get rid of 5,000 or 6,000 jobs and close down many branches. So I think we're despite what the government wants to do, they want to spend 30 billion to create new jobs, but I think we're going to enter a difficult period of recession, maybe even depression, because a lot of jobs are not going to come back. Look at the travel industry, and the airlines and the travel companies and hotels are decimated. You know, they've lost, even the National Trust who run all these big homes, so they've lost 200 million this morning. 200 million pounds they've lost because of lack of visitors. And the travel industry are really going to be decimated. And I just think we're going to see mass unemployment. I'm sorry it's doom and gloom, but I think we're going to see a lot of unemployment, particularly with young people, and a lot of jobs not coming back. Because if John Lewis closes down a branch, they're not going to reopen it again in 6 months' time, I don't think. And one of these branches was the centre of Birmingham, the Bull Ring, which is a flagship kind of branch, flagship shopping mall development. Even the shopping mall companies like Into are in trouble. You know, they're going under because people are not paying them the rents that they need to cover their loans and mortgages. So, you know, if you need to I think now's the time to tighten your belt rather than going shopping, preserve your cash and look for alternative sources of income, like maybe e-commerce, like property, like sourcing properties, which doesn't require any cash, or whatever you can find. I think now's the time to think about your future. So thanks for listening. Thanks for joining me here on Facebook Live. Thanks to Austin, Tracy, anyone else on Facebook Live. Great to see you, and have a good day and stay safe. Thanks a lot. Bye for now.